Hello everyone and welcome to the Cyclical Investors Club YouTube channel. I'm just going to film a little introduction here before I get into the buy, sell, or avoid segment of this week's video. We're going into the second week of January here in 2021. We had a few developments this week that could affect the markets. The first one was the election of two Democratic senators from the state of Georgia in a runoff election. And what that did was basically give Democrats control of the U.S. Senate and the House and the White House going into 2021. Probably should have already had your portfolio somewhat positioned for this a while back. And if not, you can adjust a little bit now. But these are things that you really want to try to predict as much as you can, 6 months or a little bit more into the future, or from the past into the future. So by last summer, I was pretty much adjusted for the most likely outcome, which was a quote-unquote blue wave in the United States. Now, it wasn't quite as big of a wave as they were predicting, but effectively they have control of the U.S. government going into 2021. So that's not nearly as important in my mind as knowing where the economy is in the economic cycle, okay? So you have an early stage, you have a middle stage, you have a late stage, and then you have a recession. Okay, those are the four basic stages of the economic cycle, and we're all about cycles here. So understanding how we fit in with that is going to be the most important thing that we care about right now. And the biggest development with regard to that was actually the development of several vaccines for COVID, because this was a COVID-induced recession. And really only the companies that were directly affected by COVID had their stock prices decline during this recession. The companies that did, and some companies benefited from COVID, so their prices actually rose. So this is a little bit of a weird situation to be in, where only part of the economy went into a recession. And now that we have a vaccine over the next year, which is what we care about, we should expect that those companies that survived will be doing better 1 year from now than they are right now, okay? So we really have a bifurcated market where some stocks could be investable as early cycle investments, but other ones basically didn't go through a cycle, okay? So if I was when I'm out looking for stocks right now, as I am, if I go beyond like the basic valuation, what I really want to look at is, was this business affected by COVID, and is the stock cheap because of that? And if I can find those stocks, I mean, those are the types that I'm looking for. Stocks that are still cheap because of COVID, but that weren't damaged so bad that they can't recover in a timely manner. And at this point, I mean, the market hit all-time highs again this week. So we know overall the market's very expensive, but that doesn't mean you can't find some deals in an expensive market, because the biggest market cap stocks, really, some of them benefited from COVID and some of them weren't hurt. And that's what really drives these indexes. That doesn't mean there's a lot of smaller companies that could have really big stock price improvement from here, okay? So just generally speaking, that's what the types of stocks I would be looking for. And then back to the political end, now that we know for certain, essentially, that Democrats are going to control the U.S. government, so what does that mean for corporate profits? What does that mean for the economy? For me, I think the way I'm thinking about it is probably any tax increases that we're going to get from Democrats are going to be offset by additional stimulus. And really what's probably going to happen, generally speaking, is that the stimulus is going to be directed more toward people who need it, people who owe a lot of money, people whose income has been disrupted. And if taxes are raised, it's probably going to be on people who have more income, have more wealth, and so forth, okay? So to me, that's kind of a wash, because normally we don't get this type of huge stimulus, okay? And we'll see how it ends up getting directed, but the magnitude of the stimulus that we're talking is so big that, especially in the short term, it should be, if anything, it might affect positively on the market. But assuming we get some tax cuts, let's say that all washes out, okay? Or at least it's hard to say and make an investable thesis on it right now. Okay, but what I think a lot of people aren't talking about, and the way I'm thinking about it, is the real change that we know is going to happen is we're going to get more regulation from this government. Joe Biden is going to get the cabinet that he wants, okay? And they are going to have a lot more regulation than the Trump administration. Now, I don't have any specific advice on what industries and what to focus on here, but the way I would frame it is, before you go to buy a stock, think about how changes in regulation could affect them. And we don't know what's going to eventually get through. But the thing with the regulations is, whereas with tax cuts, you could have some Democrats fall off and say, hey, we're just not going to support that. With regulation, a lot of these regulations, they don't need legislation. So the Congress has taken their power. They've already shifted it to the executive branch of the government. And whoever Joe Biden puts in charge of these various cabinets are going to be the people in charge of these regulations and how they're interpreted and so on and so on. So I would think about that and just put that out there. That's probably the biggest, I would say, we basically know that for sure now. We know that that's what we're going to get. We just don't know specifically what those regulations are going to be. And in terms of investing, pick companies that don't have too much danger, or at least be compensated for it. Make sure the prices are really low if it's a target industry. And a good example is, you look at the coal industry under Obama. I'm not a coal industry expert, but he made it very clear coal was already having difficulties because natural gas was getting cheaper because of fracking and so forth. But they didn't get any help on the regulatory front, okay? So they basically got hit with a double whammy, and anybody that's invested in coal during that time period lost a lot of money, basically. So that's the type of thing that I would look out for. Now, one way to I'm not specifically digging into a lot of this myself, but one way I counter that is I just try to have a good variety of investments and not be too concentrated. There's going to be people who, if you take coal or whatever, if you look back and they thought, man, I'm getting such a great deal, I'm going to just load up here and put a big, huge percentage of my portfolio here. And then they ended up being wrong, and they ended up really damaging their overall portfolio return. So since I don't get overly concentrated in any area, I don't think about this too much. But if I saw my allocations start to creep up a little bit in an industry, then I would, there should be a few red flags that go up, and you're like, okay, I'm getting over 5% of my portfolio in this specific industry. Maybe I just want to be careful because regulation could change, and that could be why they're as cheap as they are. There's always going to be people out there that work in Washington who know what's going to happen before we know it. And if you have enough resources, you can get that information. And retail investors are not going to be on the front lines of this information. They just aren't. So whenever something looks too good to be true, just remember, really think it through. There's people that know more than you do, and just don't get too over concentrated. It doesn't mean don't make a couple bets there. So when I'm making a 1% or a 2% portfolio bet, I don't worry too much about things like regulation. Because there's just too many unknowns. I can't know for sure. Maybe I'm wrong, maybe I'm not. But if everything else looks good, I'll take a shot. Okay? All right, so that's where I'm at for this week. I'm going to have a short disclaimer, and then we'll get into the buy, sell, or avoid section of this week's episode, and I'll talk about some individual stock analysis with those. All right. Hello, everyone, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and this is a channel where I share my investing process and strategies using examples of stocks that comprise the S&P 500 index. These videos are for educational purposes only and are not personal investing advice. If you would like to receive analysis on stocks that are not part of the S&P 500 index, as well as receive additional in-depth portfolio strategies, consider joining the Cyclical Investors Club premium service. It has produced market-beating ideas and strategies, costs less than $30 per month, and it helps support the investor education and research that I share with the public. With that, let's get into today's video. Hello everyone, and welcome back to the buy, sell, or avoid portion of the video. And this is going to be the second week that we're doing this, and so I want to review the performance of the stocks we talked about last week, even though it's only been a week and I'm really making medium to long-term predictions here. I want to get in the habit of checking up on the performance of the ideas that I've shared before. So last week, the buy stock that I talked about was Principal Financial. It was actually up 4.54% just last week compared to 1.97% for the S&P 500. And so it outperformed significantly. So we're off to a pretty decent start in terms of that pick. I had two sell suggestions, or one sell suggestion and an avoid, which basically fall into the same category. I might eventually separate these into two different spreadsheets so we can see the difference between the two. In one case, on the sell stock, those are high quality stocks that have just gotten expensive or something else has happened to make them a sell. So a person would be taking profits in them usually. For the avoid stock, usually there's some quality problem with the stock and we're just going to avoid buying it even though some of the other numbers might look good. Okay, so the high quality stock from last week was Nike. It was actually up quite a bit too last week and it outperformed the S&P 500. So right now it's moving still positively. The momentum hasn't changed for the stock yet. Now, if you're actually going to sell a stock like Nike that's high quality, usually I put a trailing stop on. So that way, if the stock falls about 10%, then you can take profits. But if it keeps rising as Nike has, you can still benefit from it. So if I was actually if I actually own Nike, I would put that trailing stop on last week about 10% or so. You can adjust it that percentage up and down to whatever you feel comfortable with, but that would allow us to capture some of this gain in the stock. And then eventually when the momentum shifts and it starts going down, we would just automatically take profits. So it's possible to capture this upside while still protecting the downside if you have a high quality stock or a highly cyclical stock that's still moving up momentum wise. Now for Ben, that wasn't the case for Franklin Resources. So, and as we can see, it was a total avoid because of quality issues. And when we look at it for the week, it was up, so that's good, but it did not perform as well as the index, as the rest of the S&P 500 index. So it actually underperformed for the week. So I think this is pretty much what we would expect in terms of performance for the week. But 1 week performance isn't really anything, but this will get us in the habit of checking back in here, and these lists will build over time since this is only the second edition of this segment of video. So let's get into this week's stocks, which are going to be Anthem, Intuitive Surgical, and IBM. Anthem's going to be our buy for the week. Intuitive Surgical is going to be our sell, so high quality but expensive, and so the future returns are expected to be quite low. And I'll go through all these individually here in just a second. And then IBM is going to be our avoid. So it's going to have quality issues that are going to make us stay away from the stock, even though potentially some of the other metrics look attractive, like for example an 11 PE ratio when the rest of the market's at like 30 or something. So let's get on with it. We'll start with Anthem and we'll go to a fast graph here. So just taking a look at Anthem, big picture 20-year outlook, we can see that this green shaded area here, which is their earnings per share, has basically gone up every single year, okay, in the past 20 years. There was 1 year with a slight 1% decline during the heart of the Great Recession. in 2008 and 2009. But for me, this is basically a secular growth story right here, and probably an underappreciated one, which is what makes it a buy. Now, one of the interesting things here is, now that we've had a new recession, which we're in right now, instead of starting our current cycle in 2007, which is what I would have done last year at this time, okay? When we start the current cycle, I want it to be after the last recession. Usually 2010 would be the earliest that I would start it. But in Anthem's case, they've really had, as you can see here, some really good growth the past few years, and it's projected to keep going at that rate. So I thought that for Anthem, let's see what year I chose for them. I believe it's 2015. Yes, 2015. Okay. So we want to start the current cycle in 2015. So I'll adjust this up to 2015. So this is what we're dealing with right now, okay? And we can see that it's pretty consistent. We get a pretty good idea of kind of what they've done the past couple years and what they're expected to do here. And I think it's a pretty fair assessment of what we can expect, provided there aren't major changes to the healthcare system, which there could be. But I'm going to assume that really dramatic changes aren't going to happen. And so far, analysts are expecting 13% growth and 13% growth for the next couple of years. The basic fast graph growth rate is 15.73%. So I calculate my own growth rate, and that takes into account any dips that we may have had in here, which we didn't have any dips, but we did have some years with slower growth. Those will be taken into account. I'll also take into account any buybacks that they might have made. Okay, so let's see what some of the statistics are here. So I have Anthem listed as a secular growth stock. Its full cycle average P is 14.86. So this can be found right here on the fast graph. Okay, and that will change depending on what time frame you use. So if I was to use a longer time frame, it will change. You'll see it's down to 12, right? So they've traded at a higher PE ratio in more recent years when they've had faster growth, which makes total sense. Also, interest rates have been lower, so that makes sense too. Okay, but so that's what I'm going to use. And what I'm going to look for is, what's the difference between their average PE ratio and where they're trading at right now? Okay, and so basically it's the difference between this PE ratio and this PE ratio, and what would happen if everything else was held the same, but this PE ratio adjusted to the long-term average. Okay, now in order to get this PE ratio, you have to decide what type of earnings you're going to use. For me, for these guys, I just used forward earnings of $25.30. So I'm pretty sure. I'll double check that. I keep that down here. Yeah, right there, 25.3. So this is going to use forward earnings, and with forward earnings for 2021, currently they're trading at 13.32 PE. If that over the course of 10 years reverted to the average of 14.86, that means the price would rise, and you would earn 1.1% per year for 10 years. Just from mean reversion, just from the market saying, okay, we feel the same way about it this cycle as we have since 2015, basically, for the next 5 or 6 years. So, or 10 years actually in this case. Now next, what I want to do is I want to figure out what this growth rate is, okay? So if you look at the fast graph, they calculate it for you from point to point, which is 15.73 just using the fast graph. But sometimes when you take into the share buybacks, fast graphs use EPS, and I also take into account any down years for EPS that might have occurred. So in Anthem's case, they didn't have any down years. So you would expect my number to be similar to fast graphs. They did buy back 7% of their shares during this time. So if you look at the difference between the fast graph number and my number, mine's a little bit lower. That's because I'm taking into account these share buybacks. Okay, so I'm just slightly more conservative than fast graphs, but if you're using fast graphs, that number that they're using is right here. If you have a secular growth stock like this that doesn't have any down years and they aren't buying back a lot of stock, the fast graphs number is going to be very similar to the number that I usually come up with. Sometimes that's not the case. If there's a big difference in buybacks, as we'll see later with IBM, there can be more of a significant difference in the expected growth rate. So this is how much I expect earnings to grow based on the past 5 or 6 years over the next cycle, okay? Now, if we invested $100 at today's price and it grew at this rate, okay, it would turn into $279.23 over the course of 10 years. I pull forward the first year of growth, so it might be slightly less than this in real life, but this is the way I use it to calculate the expected business returns. So unlike the mean reversion, which is right here, the business returns don't rely on the market at all. So they don't assume the market will do anything. This is only the earnings you would get from the business. So if you just bought the business and kept it, and you bought it for $100 and you kept all the money that the actual business would earn, and this growth rate is close to being correct, this is how much money you could turn your $100 into in 10 years. What I do is I take that, I convert it into a CAGR, and this is the return annual return you could expect to get just from the business, okay? So just from the business, you're going to get a 10.81% return buying Anthem at today's price, and assuming if this growth rate actually happens. That's a really good return. So, and then combine that with the mean reversion, and you get a 10-year CAGR of almost 12%, which is my buy threshold for stocks. So the price dips just a couple cents, we would be over a 12% expectation. And you can see a very low PEG ratio here. This is actually low by pretty much any standard. Even back in the old days when we considered a PEG of 1 to be good, Anthem meets that standard. 3-year revenue is a check that I do to see if maybe the business is being disrupted. This is how much revenue has grown over the course of the last 3 years. Usually I measure it up until the beginning of this recession. I think this one I just went ahead, it's so high that I just went ahead and just measured it even through this past year because it hadn't really been affected too much. For stocks where it has been affected much, I just stop this measurement in March when the recession started, because what I want to see is, was something wrong with the company, or were they getting disrupted? Were revenues declining before the recession even happened? So if that happens, that's a warning sign. Theirs looks totally fine. That looks great. So that's about 10% per year, because this is 3 years cumulative, not annual. So 9 or 10% per year. And that's totally fine. This is almost like a pretty close to being a black and white thing here. If it's negative, I absolutely don't buy a stock and I would sell it. If it's positive, that's fine. If it's right on the border, then it's kind of iffy. If it's just barely positive, then it could kind of tip either way. You just have to use some judgment. But when it's 30%, it's just no big deal. So the recession PE over this time period Anthem's only 15% above it. So it's totally fine. Even if there was another recession, the stock probably wouldn't fall that much. Okay? Unless it was something unique, that uniquely affected them. And so that's about all we need to know here. I have other factors that I check, but nothing came up negative for them. Probably the biggest thing is obviously going to be political. If there are big changes to healthcare, it could affect them. So, and that's probably why the price is as low as it is right now. But I usually spread my bets around. I take 1% portfolio positions or 2% portfolio positions, nothing higher than that. And for a 1% position, you take your chances. Maybe the government will mess things up for them somehow. But if they don't, then they should do really well. And they might be able to adjust to anything that the government decides to do. With a 50-50 Senate, it's going to be difficult for them to get anything too radically passed, I think. So for me, this is a buy. I'm long the stock. And next, let's move on to Intuitive Surgical. Okay, Intuitive Surgical. Let's pull them up here. And we'll take a look at them. So in this case, this is going to be my sell for the week. And it means it's high quality stock, but the future returns are going to be really low because the stock's so expensive. And you can see, just glancing at it, this huge rise in price relative to earnings. Okay. And even when we, let's see what year, 2013. Even when we make this period shorter here to the current cycle, all right, there's still just this huge gap. And even if we assume that earnings recover from COVID, there's still a big distance here. Now, and that just means the stock's expensive, which in turn means the likely future returns are going to be low. If you just look at the earnings yield, which is, this is using the fact, this is a little low, I think, and I'll show you that in a minute when I get to my calculations, because it's using this earnings for this year, which are depressed. So I'll use these earnings when I use mine, which are recovered. But if you, just a way to think about this is, if you bought the company for $100, it would only pay you back $1.19 per year, if this was the accurate earnings yield. So you think about how long it would take you to earn your money back on an investment like that. Well, if there's no growth, it would take 84 years, right? But they have some growth. So we'll get into calculating that, and I'll show you why, even using pretty generous assumptions, that it's still expensive enough to take profits in, basically. So if we go back to Intuitive Surgical here, this one has moderate cyclicality, earnings cyclicality. You can see there's a -4% here. Now the current downturn is unlikely to repeat, I think, because this is COVID related. So we have a 24% drawdown during this recession, and because of, surgeries and elective surgeries and things have been put on hold because of COVID, since the next cycle, which is what I care about, is unlikely to be COVID related, this is probably unlikely to repeat. So when I run my numbers, I'm just going to pretend like this didn't happen, basically. And because I want to be as generous as possible if I'm considering selling a stock or writing a bearish article on a stock or making a video. So we see they have a down year here. They have a down year here. It's mostly a secular growth story, but they have some modest earnings cyclicality. Okay, so long as we ignore this, which I think we should. Unless you think, within the next 10 years, we're going to have another similar type of outbreak that we had this year. So, all right. So now that we covered that, let's just take a look at the numbers. So when I use their earnings from 2021, what they're expected to be, 13.18, this PE goes down a lot. So it goes down to 35.82. So if you just glanced at it and you didn't really understand what was going on, that you thought the market was just crazy for having it traded at 80 PE or whatever, well, it's not, because the market is looking forward. The market's saying this is a 35 PE or 36 PE stock, okay? So big difference between that and 80, and this is a much more generous assumption for them, all right? Now, oh, I'm sorry, this was the average PE during this time. So they already had a high average. The current PE is 62, which is lower than 86, but is still quite high. And that's using, again, these numbers right here. So I had to correct myself a bit there. So we see 62 PE. If it goes down to 35, which is already really high, you would lose 5% a year for 10 years. So just adjusting to the average of the past 7 years or so is going to lose you money if the market just starts feeling the same way about the company as it felt during the past 7 years. These guys haven't bought back very many shares. The Fast Graph's earnings growth rate is 11.37%, okay? So let's take a look at that. So 11.37%, but they're measuring from this point to this point. And since I'm being more generous, I'm measuring up to this point, okay, after earnings have recovered from COVID next year. And so this is a rare case where my earnings growth rate, and they also haven't bought back very many shares. So this is a rare case where my earnings growth rate is actually higher than FastGraphs. That doesn't happen very often, but I'm being more generous to the company here, and that gives us a 13% earnings growth rate. So same thing as before. If we invest $100 at a 62 PE, and it grows at 13%, we're looking at about $134 after 10 years on our $100 investment. That's not a very big. That's not a very big return. It's like 3% per year. And then you take that and you add it with the mean reversion loss, and you're actually probably going to lose money over the next 10 years on this stock. Even though the business is great, it's growing double digits. Things, once they recover from COVID, things look fine. If the market starts feeling the same way that it used to feel and it values it at a 36 PE, which is still very generous, buying it at today's price is going to produce negative returns. So it's just a case where you can get a really high quality stock and pay too much money for it. Now there's always the possibility that they find a way to grow faster than this. If you look at what analysts think, so after this first year, they're looking at 19% for the next year. So my 13% is a little bit lower than that, but I mean, it's not that far off. They would probably have to grow at like 25% for several years or something in order to justify a 62 PE. So if I own this stock, I'd put a trailing stop on it, maybe like 10%. And then if this momentum here ever switches and turns down, you'll take profits somewhere up here, and that return back down to this blue line, you'll not suffer, and possibly below the blue line. I mean, look down here, there's been plenty of time where it traded below at a 25 PE. So definitely be prepared to take profits in this one if you own it. I don't own it. All right, let's move on to our avoid for the week, which is IBM. So let's take a look at IBM here. I've written about IBM before. It's kind of a classic value trap that I would avoid. Okay, so if we take a look at IBM's long-term earnings, you can see a big difference between their earnings pattern compared to Intuitive Surgical or compared to Anthem. So for many years, IBM was a fantastic stock to own. This period here showed great growth. They grew right through the Great Recession, and they attracted Warren Buffett sometime in here. And because he could see the same thing here, and it looked pretty cheap at the time, like 13 PE of 13. So it all kind of made sense, and then it all basically switched and changed, and earnings started to fall. They more or less kept falling. During this recession, they fell even more. They're expected to partially recover. Okay. The key with this, and now it's a little bit easier, but the technique that I'm going to show you would have predicted IBM problems right in here. Definitely by 2015, it would have given a sell signal, and that is the 3-year revenue. So let's just take a look. There are two things I have on here. Now, first of all, IBM looks cheap. Looks like you'll gain a little bit if the PE reverts to what it has been during this past cycle. Let's see what years I used here. 2010, right after the last recession. So I actually included some of their good years. Okay, so this is what it looks like. So you would gain a little bit there. But look, they bought back a lot of shares. Almost a third of the company during this time period. And the fast graph gives us a small earnings growth rate of 1.55%, which is very low. I usually like to have this at least above 3%, even on my kind of no growers. But once you take into account these buybacks, earnings really have shrank during this time. So they shrank about 1.52% per year. And that's what you see reflected in. So this green portion here, this dark green portion, doesn't reflect those buybacks. So this is actually steeper. And I'm going to use these recovered earnings. So I'm not going to use the low earnings. I'm going to assume they bounce back a little bit just to be extra generous. But even doing that, the earnings growth rate is negative. So for me, that's just an avoid right there. But that really wouldn't have happened until this past year or so. For 2 or 3 years ago, this would have at least been positive. It didn't turn negative until recently. But what did turn negative pretty early was their 3-year revenue. So this number is actually, I think, leading into the recession. And it's even lower now. So their revenues have been falling for a long time. I think this first would have went negative in 2015, if I remember correctly. I don't remember for sure. It was right in here somewhere. So you would have had a warning way up here watching those 3-year revenues, and it would have saved you, a decline from there to here. So if you include dividends, you basically were flat. Cash would have performed better. So they have a high dividend yield, so that might have helped save you as an investor. It kind of saved Buffett because he basically ended up breaking even on this, even though it ended up being a dud. So sometimes these guys will give you enough time to get out if you do make a mistake and you get in. I mean, when Buffett bought it, revenues were not negative. Earnings were growing fast. It looked pretty good. But when that shifted, he eventually got out because he recognized it was a value trap. So I would definitely avoid IBM, even though it has a high dividend yield. It has a name everybody knows. They're sort of a tech company. I mean, they are a tech company. But they've been disrupted. They've made acquisitions. They've done all kinds of stuff to try to turn things around, but they're really struggling. In the future, they might turn things around. But I invest in things that are going well and that are expected to go well, and that basically just need to keep doing what they're doing in order to be successful, that are also trading at good prices. So IBM's not one of those I would avoid. I'm going to put it in the avoid spreadsheet, and we'll track and we'll see how it does relative to the market from here. So those are my 3 stocks for the week: a buy, a sell, and an avoid. And we'll continue to check back in on these on a weekly basis, and we'll see what happens to them. Thanks for watching the episode this week, and hopefully I'll be able to bring us new episodes about each week going forward. If you haven't subscribed yet, we're just getting started with this channel. Go ahead and click the subscribe button, and you'll be notified when I post new videos. Thanks for watching. Later.